On this one, we're going to talk all things cash flow. It's the thing that businesses need. It's the oxygen that businesses come to breathe. It's the thing that we need to survive, and it's the thing that we need to thrive. If you don't know what cash flow is, that's okay. This video is still for you because we are going to go into exactly what it is and what you can do to change a negative cash flow cycle into a positive one. You're going to learn exactly what I did when I walked through a $2 million business making $500,000 loss, and what I did overnight that really helped them turn their business around. So without further ado, let's get into the video. My name is Daniel Shepherd. I'm a UK entrepreneur and investor. I employ over 125 people and generate over $10 million every single year in the property, industrial laundry, and self-storage business. Now, if you want sharper business thinking and you're ready to make a difference to your journey, then you're in the right place. So first thing, if you don't know what cash flow is, in a very basic term, it's money in versus money out. It's very key that you need more money in than you have money out. Otherwise, if you have more money out than you have coming in, that is determined a negative cash flow cycle. So by definition, we want a positive cash flow cycle to ensure we are left with more than what we come to spend, and that's how business works. So why is it, or how is it, that businesses end up getting into a negative cash flow cycle? So there's a couple of reasons why businesses get into a negative cash flow cycle, and sometimes that's not all their fault. But it's what happens, and it's your job in order to make sure that doesn't happen. One thing that in a B2B setting, so that's business to business commercial terms, you need to have credit terms and you need to have a cash collection process. So what are credit terms? Well, those are the terms that you set and agree between you and the client to get paid. In a typical business to business game, you're going to find that you're going to be dealing with postponement terms. What that means is you've got to deliver the goods and within 30 days thereafter, you're going to get paid. But what happens 9 out of 10 times? People stretch payment terms and they will try and stretch as long as they can until you give them a nudge, and sometimes have to have that difficult conversation with them where they need to cough up and pay for what is being delivered. So that's the first point of what I would do. I would simply change your business terms overnight. So that's what I did with Telford Laundry. They were $2 million in turnover, over $500,000 in the hole, and they were cash flow negative over by 45 days. And they was absolutely killing the business. Anything to help improve the business. We couldn't make any investments. We couldn't even really meet payroll. So if you're there scratching your head thinking, oh my God, on Friday, I've got payroll to do. I've been there. I completely understand the predicament that you faced and really not knowing where to turn. So there's a really couple of things. There's going to be some micro little tips that you can swipe and deploy to generate instant cash flow for the business overnight. And there's going to be more long-term plays where it's definitely going to set the foundation of your business operation to ensure that you have a positive cash flow cycle, and that becomes the positive foundation for your organization. In our group of companies, we have a 7-day postponement. Any services rendered in the month of August, for instance, will be due on the 7th of September. It doesn't matter whether we raise the first invoice on day 1 or we raise the last invoice on day 30. You're going to owe everything that we delivered in August. You're going to owe it on the 7th of September. Why do we do that? Well, we want to keep our cash flow positive. So typically, our vendors are going to be charging us for 30 days post-month or post-invoice, and typically we receive invoices once a month. So what that means is by bringing in a 7-day positive cash flow cycle, so all our clients are paying up by day 7 of the following month for the month previous, we've got roughly a 3-week period of positive cash flow where we are then not having to pay our vendors until week 4. Ensure that all your outgoings are on the month end and make sure that your cash collection cycle is at the beginning of the month. And then that period in between, you're able to make some real good decision making, whether that be put it into a savings account, easy access, instant access, and just earn a little bit of interest from it, or you've got other different requirements for the cash. Look, we don't want to get into how you spend your money, but more importantly, that you need to just generate it. So it's something that I've did at Telford Laundry when we walked in through the door, and we've never looked back. So what you've got to do is have a very hard and fast, this is what we're going to do, and these are the reasons why we need to do it. 9 out of 10 times as well, depending on what your cash flow collection looks like, will determine how skeptical your clients will be to this new way of working. So if you just say, this is the way that we always done it, new clients are not necessarily going to bat an eyelid because they don't know anything different. If they want to do business with you, if you've got a unique offering or whether you've got a good quality product or anything in between, and they want to do business with you, they'll simply accept the terms. Even if they try to push back on your credit terms, you can simply say, sorry, and they go, okay, fine. Even so, when I've really had a hard pushback, so maybe that didn't work, I always say, can you make an exception to if we deliver the products as we say? Are you facing challenges that are forcing you to use our products or services now? Because like the reality is, if they're moving from one operator or one supplier, then there's going to be causation as to why they're coming across to you. Anyhow, really important. That is probably the one key first principle I would do in any business, is to change the credit terms to 7 days, end of month. And it's a real unique opportunity then to generate that cash flow cycle. For those that are paying people on a weekly or bi-weekly basis, and we were one of those, I would suggest that you move it to month end. And what we do in order to keep the reporting nice and clean, our employees would get paid on the 7th of the month for the month previous. And what that does, it really keeps our reporting nice and clean, gives us the ability to manage our workflow, allows us to correctly administer the employees' pay slips and so on in good timings, that we can make the necessary adjustments. And now we've got cash coming in on day 7 and our employee or payroll goes out on day 7, we are never short of cash, ever. Next thing, now typical vendor payments are 30 days. What you can do is negotiate. When was the last time you ever picked up the phone and had a conversation about credit terms with your vendors? Within our group of companies, we do this every 6 months. And the reason why we do this is that we keep them on their toes. We keep a good, positive working relationship. We understand our credit terms. They understand our payment terms. And we also have a mutual understanding of the service and the products that we come to expect. So really critical piece of advice. If you can pick up the phone tomorrow, today, whatever it may be, and say, hey, Mr. Supplier, I want to be transparent with you. I've had another offer or opportunity that has enabled my credit terms to raise from 30 to 45. Are you prepared to match? That they're going to say yes, because they want to keep your business at the end of the day. So what you're doing is extending the day payments to your vendors or suppliers and increasing that cash flow cycle positive. So what you are doing, you're extending your payment terms and extending the cash cycle. So you're increasing the positivity of that cash effect within your business and getting that cash cycling and giving you the freedom of options with that cash. It's a really important thing that I would suggest that you do. And in some instances where vendors have outright refused because of one reason or another, it's not part of their standard terms, etc., I would always then try and put it onto a credit card, because the credit card offers a variety of benefits, right? But what most credit cards do, they have extended payment terms. So for instance, you have 50 days, 60 days payment terms with your credit card. So even though that your vendor doesn't accept extended payment terms, you can still achieve it in a very entrepreneurial way by just simply putting it on a business credit card. Plus, then you're covered. If they didn't deliver the products or services, or you have a problem, you can always rely on the credit card to make it right. Another one is climate payment methods. So for those that don't utilize the likes of card payments or direct debit, I can only highly ever recommend it. We always, as standard process, we will only move forward with any business to business transaction direct debit basis. What that means is that on that 7th of the month, we can collect the amount that is due for the month previous, and we don't have to worry about the excuses of collecting or forgetting or the right person wasn't in, etc. And we collect over $500,000 every single month in direct debits. And it's something that we can rely upon, we can plan on, we can build our business on, because we have this recurring revenue that is generating effortlessly, and it gives us options. So one, always try and put a direct debit system in place. Now it's very different. If you've got a product supply business and it can vary from week to week, month to month, and your customers may only spend once or twice a year, right? Direct debit may not be for you. So I completely understand that. Nonetheless, you can have a variable direct debit. So it's somebody that's set up an account. So if you have not got clients that have accounts with you, I can, again, recommend that you do that. Track the data. Data is key, and what gets measured gets improved. And if you get key accounts, you're building up a database where you're able to market, you're able to communicate effectively, you're able to track and trace internal notes and interactions to help understand how you are managing your business. Even if your client only spends once or twice a year with you, and let's say you have standard credit terms of 30 days, but after watching this video, they're going to be 7 days, you can reliably and confidently collect that that as and when they've spent money and the money is due. So I would always, as part of your credit account application document and process, get a direct debit mandate in there. Get it in and amongst your account documentation as a standard piece within it. Don't do it as a separate document because something separate is going to cause separate questions. Just put it in the account form process, and 9 out of 10 times they'll sign it without thinking. So do that. Alternatively, card payments. Now we have a variety of means to take payments. We use a system called Stripe. It's a really low cost, easy to use. It's widely known within a lot of spaces, e-commerce, B2B and whatnot. Stripe is an online platform. It gives you the means to take card payments either online via a website, via your accounting software, or as a standalone. It means that you don't need this PDQ machine, and it's very low cost for what it is. So it just gives people's options. So whereas I mentioned on the roles reversed to our vendors, we would put a credit card payment on if they're not prepared to extend. Well, clients can do that for or to us. Bearing in mind as well, to keep that cash flow positive, you don't want to be incurring the unnecessary fees in a B2B transaction. So make sure you charge relevant card transaction fees to ensure that you don't incur that cost. What about the cash collection process? And more importantly, what about the things that you're not doing? So if you are not picking up the phone or having a relationship with your clients and you're not keeping in touch and you're not sending them statements at the end of every month, well, I suggest that you start doing that now. Those are really simple things that you can do that will cost little to no money, but will really help you manage your cash flow cycle. So at the end of every month, religiously, regardless of if anyone owes you money or not, if their account sits at zero, they get a statement, because what that does, it keeps them a reminder that you're still here, and it keeps them a reminder that their account is still open and that they can spend money with you. So send a statement every month to say, hey, this is your statement, this is the outstanding balance, this is what is due 7th of the month, we're going to be collecting it. Or those that are historical and you've had a really tough time getting on the new ways of working, then it's a case that they get a prompt that they need payment. So there is that. Now, most accounting systems, now if you don't have an accounting system, I can recommend that you need one. It's absolutely essential to get an accounting system. We use Xero accounting software, there's Sage and lots of others, but they all do very much the same thing. There is going to be a report called Income by Contact and Age Receivables Report. So the Age Receivables Report gives you a summary of every client and what it is that they owe, or the amount that they owe, by how much they're overdue and in which month of which they're owing. We review it religiously, that report, every single week, and it causes then the priority list of our cash collection process to ensure that our team are speaking to the right people at the right time to ensure that the cash is received at the right date. Those are not on direct debit or doing a different kind of service. So really in doing automated. Now, again, these accounting software systems sometimes have the ability to send auto reminders for outstanding invoices, and they'll automatically send the statements. Really great. It's worthwhile doing. However, lots of clients become kind of numb to accounting software emails. Either ends up in their spam or directly in the archive bin, whatever you want to call it. You need to have some automation outside of the accounting software to say, hey, your account is due and this is the amount, and we'd really appreciate you settling it early or by this date. Just having like some prompts outside of the accounting software is ever so powerful. You can use other systems that will be out there that will integrate with your accounting software, but send it via different means. Look into it. It's worthwhile, and I think it will help bring your cash cycle forward. So let's talk about the things that you can do when you're a construction firm or a gas fitter or a plumber and you're doing a bathroom or whatever, and you want to try and find clients that can afford £2,000, £3,000, £4,000, £5,000, or big projects, 100k plus, and the customers don't have the cash right now in order to pay for your project. You can introduce third-party lenders to your clients. So in the consumer world, you'd have Klarna, for instance, where they can spread payments interest-free for 3 months and then interest thereafter. Well, in the world of B2B, you can still do that, and there's software called iWoca, IWOCA. It gives B2B clients the means to spread your bill, your invoice, over 3 to 12 months, and it removes the barrier. You get paid immediately from iWoca. Everyone's kind of happy. The products and the services will be rendered to the client. They spread it over 12 months. You're not waiting for 12 months for payment. Everyone's a winner, and you didn't lose out on the sale because the client didn't have the cash. So if you haven't done it before, I suggest that you do it now. Reach out to the likes of Klarna or iWoca, recommend third party, introduce third party. Sometimes you can get a kickback, which obviously improves your bottom line. Sometimes you don't. You're doing it to get the sale and you're doing it to get paid. So bear that in mind. Another one is changing the credit term cycle so you get paid in advance. Now, there are very unique scenarios where you're able to do just this. So if you've got a reliable product or service that you're going to be delivering every single week or month of the year and it doesn't change, then you know exactly what your invoices are going to be in month 1, month 2, month 3, month 4. And therefore, you can charge for it in advance. Most people just don't. But it's very easy to. You just charge in advance. Beauty of it, but what it does, it brings your cash flow forward. So you're able to get paid 1 or 2 or 3 months in advance, depending on your business setting and the industry that you're in, and bring that cash forward. It's far more powerful. It gives you far more options. It gives you ability to invest in human capital, plant and equipment, resources, marketing spend, etc. Because you're pulling the cash forward in advance of rendering the services. So lots of maybe business to consumer can utilize this. So lots of Thomas Whatnot will get paid before they actually come to deliver it. Okay, you've got to manufacture it and etc. behind the scenes. But in principle, they get paid before they actually deliver the product to the client, right? And you can do exactly that by just charging in advance. So raise that invoice 4 weeks or a month in advance, and then you collect that payment a month in advance. It's very simple. But what you're going to be doing is really changing and flipping the whole negative cash flow cycle on its head into a real positive cash flow process and cycle. So that's a really key piece. If you can do it, analyze your clients, analyze your industry. If you've got predictive revenue and it doesn't really differ from 1 month to the next, get a cash in advance credit term process in place. Okay, let's talk about some of the quick fire you're able to do to generate cash tomorrow. If you needed payroll tomorrow and you didn't have it, you could look at that income by contact, filter it to your top 10 clients, offer them a 1 to 5% discount and see what the reaction would be if they paid today. Now, I've had positive experiences with this and I had pretty much a 90% success rate and had the cash ready to meet payroll. Everyone loves a discount, and if they can see that it comes straight off their top line, what's there not to like for them, you also receive it. And let's be fair, you need it. There's going to be a cost if you needed the cash from a third-party lender anyway. You need to look at the mechanics and the cogs within your business so that you don't find yourself in a repeated position just like that. So that is point 1. The next point is ask for deposits. Deposits is such a funny thing. Like, lots of people don't think about deposits in industries that don't typically charge deposits. But it's only the narrative and the framework or how it's framed to the client as to whether it's the norm or not. And I've met so many different people recommended this exact strategy and it's really worked because everyone gets it. Everyone understands that what goes into setting up an account, whether you need to invest in product or services or human capital, etc. People get it. And people either see it as an investment. And at the end of the day, you want to work with clients who understand what goes into delivering your services and products and become that integrated partner or product that they need for their organization. So whether it's a £500 deposit, whether it's a 10 grand deposit, depending on the context and the nature of the project that you come to agree with the client, always ask for a deposit, because what's the worst? You can always take it off. You can never put it back on. And as standard, just maybe 10%, 20% of what you expect to invest within this product or service that you come to render to the client. Just do it. See what happens. And you'll be surprised how successful you will be. And what that does do, you get cash in advance to pay for your products or services before even delivering them. And it really helps with that investment and capital that goes into whatever you come to do. So ask for deposits. Next one is categorizing clients and ditching the grade D clients. So depending on your industry and your business model, I'd suggest that you categorize your clients, and you can categorize them for a variety of different reasons. One could be revenue, so how important that they are in revenue. Most important, what I would suggest, is profitability, so you can understand who are the most profitable. And then you'll start developing a league table, A, B's, C's, and D's. Now, the D's will probably turn out to be some of the least profitable and maybe least turnover, and probably the most painful in terms of service or product delivery, and ditch them. Because the reality is your resources are worth more to you in time, cost, and wasted resource than it is to be allocated to something that isn't actually paying. Now, nobody wants to let go of turnover, but an old saying where turnover is vanity and profit is sanity, and that is ever so true. So make sure you ditch the grade D clients, because at the end of the day, you want to focus your energy on delivering a profitable business to your team, to your clients, so that you are there consistently for years to come. Ditch them. Next one is also paying for things that you don't have a Scooby what you're paying for. So if you've got direct debits that you have no idea for, log on, cancel them, see who gets in touch. Don't go cancelling the obvious ones, the finance agreements or the vehicle leasing agreements, etc., that you know exactly what they're for. But the things that you don't, cancel them. At the end of the day, they'll get in touch and they'll look at renegotiate or get that back on, that direct debit back on. And it's up to you whether you say yes or no. So take control. The difference is when you have a direct debit on your account, you simply don't know when that's going to come out. And if you are not working with a reputable business who has consistent direct debit dates. So for instance, if your clients know that you're the 7th, all gravy, it's handy dandy. But if you've got unknowns and you're getting hit with bills for the same thing, but it's coming out in week 1 or then week 3 and then week 4 or whatnot, very hard to plan from a cash flow perspective. So get on your direct debits and get them cancelled. If you even implement half of what you've learned on this video, I guarantee you're going to generate positive cash flow difference to your business. And even so, you're going to have options. Your cash balance is going to increase more than you've ever seen before, all by making the simple tips and tricks. So if you do what you always did, you'll always get what you've always got. And what that basically means is that if you don't question the status quo and you don't try and do something different, then you'll never ever get a different result. So if you're used to being in a cash flow negative situation and you want to do something about it, make sure to implement some of the tips and tricks and golden nuggets that you've learned on this video. Let me know which ones were most successful in the comments. Make sure to subscribe, drop a notification, and I'll see you on the next one, guys.